Well, I am Jim Grant, and this is Grant's Interest Rate Observer of the Air. And with me today, Edward Yardeni, who is first and foremost a father of five. Secondly, is the eponym proprietor and brainbox of Yardeni Inc., consulting economist. And but I don't know, Ed, you're a PhD in economics, but I think it is part of the high praise I'm about to lavish on you that you'd never know it.
Thank you. Thank you very much.
Ed and I go back to the year 18 was, no, it was 19 something or other. Ed got out of Cornell in 1968 and went to Yale ever so briefly to attain an MA, I guess, or something like that, and then a PhD in economics under the inimitable James Tobin. And he has worked all around the place on Wall Street, not to mention the Treasury, the Fed, and the Federal Reserve Bank of New York. He jokes that he can't hold a job, but he has certainly held his clients who hold him properly. Ed, you have been the vanguard of thought on things as varied as demographics, interest rates, the Cold War, and digital technology.
I've been keeping busy.
So I think I'll stop talking now and welcome Ed Yardeni to Grant's Interest Rate Observer of the Air.
Thank you, Jim. We do have a long-standing history together, and when you think about it, that's kind of an unusual part of the business we're in. There are very few professions where we basically go through the same ups and downs.
Well, you have had so many ups, and by the way, how could I have forgotten, as a sometime author myself, to fail to mention that Ed Yardeni is the author of Predicting the Markets, a professional autobiography, which is just out, I think, anyway.
Yep.
Ed, so here we go. So way back when interest rates were 15% intraday, September 30th, 1981, on the 30-year U.S. Treasury, 25 years non-call, and you were bullish on them. And over the succeeding 35 years or so, interest rates went mostly down, sometimes sideways, ever so infrequently up. And in the course of that generation-length bull market in bonds, stocks prospered, you prospered, your clients prospered, you were there saying the right things almost all of the time and prescient things almost all the time. Okay, so I ask you, with those set of formidable credentials, have rates bottomed in July of 2016? Is it possible we saw a secular low in interest rates? And if so, will we, I now ask you as a movie critic, will we see that glorious movie play in reverse, the 35-year movie in reverse?
Yeah, I mean, our business really isn't that difficult, right? Things can, like bond yields can either go up, down, or sideways, so should be able to pick out.
You'd think, wouldn't you?
You would think, right? So I think that they're probably not going to go back down and retest the lows. So I'm not thinking they're going to go much higher, though everything is relative. I'm thinking that the bond yield should be trading closer to nominal GDP. If you look at a chart of the year-over-year percent change in nominal GDP versus the bond yield, they're always kind of in the same neighborhood, but never, very rarely identical.
So that's so nominal GDP is 4, 4.5?
4.5%.
All right. So what would 4.5% do to earnings multiples?
Well, it would bring them down, but the question is, will that bond yield go back to 4.5%? I think the answer is going to largely depend on inflation, and I continue to believe that there are very powerful secular forces keeping a lid on inflation. So if inflation is going to stay, arguably, I would argue, for around 2%, I could see the bond yield going up to 3.5%. And I don't know that would hurt multiples all that much, quite honestly, because I think, we've had abnormally low interest rates, and normalizing them in an environment with low inflation and maybe a longer expansion could keep multiples relatively high.
Ed, interest rates are prices. We at Grants, talking our book, contend they are the most sensitive and important prices in capitalism. They have been under the thumb of central banks the world over. What risks lie in that fact?
Well, that's a very important issue. The bond market has been rigged on a global basis by the central bankers. I guess I was for QE1, where the Fed bought the initial slug of treasuries and mortgage-backed securities. But once they got the Fed funds rate down to zero and they couldn't think of anything else to do other than buy more treasuries and mortgage-backed securities, I argue that maybe they should just say, we're done. We can't really do any more than lower the Fed funds rate down to zero. So I really was not a big believer that they should meddle with the bond market as much as they did. But just to cut to the chase, the ultimate risk is that inflation comes back just as the federal deficit's about to widen because of tax cuts, and the Republicans and Democrats figured out the best way to keep the government open was to spend more money. At the same time that the Treasury, that the Fed is on course to raise short-term rates.
Well, we've pointed out in grants that if you take the prospective sale out of the Fed portfolio and the prospective issuance by the Treasury next fiscal year, we are selling from official sources more government debt than at any time as a percentage of GDP since 1945.
Yeah.
So so does that matter?
I think it matters if inflation makes a comeback. I mean,
Okay, here's a question about inflation. Okay, so they don't issue a press release proverbially, right? Things sometimes just happen. So in the early 60s, inflation was running very cold, sometimes less than 1% year over year in the CPI, and nobody seemed to think that was clear and present danger to the Republic as they would today. But suddenly, 1964, 65, 66, not suddenly, but gradually and by degree, but seemingly out of left field, the inflation rate was not a 1 number, but a 4 number.
Yep.
And, so if you look, what caused that and what might cause an unexpected uptick in inflation
Well,
now?
I think the big surge in inflation clearly coincided with the increase in the price of oil in the early 70s and in the late 70s. And back then we also had much more powerful unions that had cost of living adjustments, and why a worker should get compensated for their gasoline price going up from an employer standpoint really doesn't make much sense. But if you got a cost of living adjustment in your contract, then you've got to pay that increase. So price shocks went right into wages, and then it kind of became a spiral. And at the time, in the late 70s, everybody thought that it was going to be the problem forever. And Volcker demonstrated that you could really bring it down pretty quickly if you just kind of squelched it. I think globalization is here to stay. I mean, clearly it's about to get stress tested by Trump in a big way. But I think there's just too much at stake here in interactions in global trade and competition. I think technological disruption has never occurred at a faster pace. They can't quite quantify that, but qualitatively, from reading things about what happened in the past and what's happening now, it seems as though technology is disrupting more business models than ever before and fundamentally deflationary. And then there's aging demographics. So, but you're right. I mean, inflation could be inflation is the big risk. If it makes a comeback, then I'm going to have to rethink my outlook for the bond market.
And the CRB Raw Industrial Spot Index, that ancient, seemingly irrelevant, and on its face obsolete index, what does it mean to you, and what is it telling you?
Well, in my book, I kind of indicate.
I'm going to hold the book up to the microphone so people can see this thing.
That's
All right.
Okay.
All right.
In my book, I kind of go through a lot of the economic indicators and try to explain what they're all about. And I did that partly for myself, just to remind myself and to catch up on things.
Well, it's a fine education in what matters.
Yeah, well, it's what Ben Bernanke once called current analysis, as opposed to what you learn in graduate school. But the CRB Raw Industrials is my #1 favorite.
What is it doing now?
Well, first, like you said, it's been around forever, so it's got some funky things in it.
Okay, but what is it doing?
It's going up. It's been going up ever since the beginning of 2016.
Tallow and lead and burlap and turpentine.
It's also got some stuff we understand, copper and lead and tin.
So it's going up.
Yeah.
And when does its rate of rise signify some imminent problem with inflation to you?
Well, to me, it's more an indication of global economic activity. That's the way I use it. I use it more as an coincident indicator of the global economy.
Which is strong, right?
Which is strong.
Yeah. Okay, so you mentioned current activity as opposed to prophesizing.
Yeah.
Okay, so this podcast, Edward, was to have been held on Wednesday.
Right.
The weather forecast was portentous. It was threatening. There would be snow, howling winds. It didn't happen. All right. Okay. So big data is now in the service of weather forecasting. I mean, how much data could the National Weather Service? It must have trillions of sightings of stuff, wind patterns, temperature gradients, and they miss. All right. So that's weather, right? Weather does not watch CNBC. It doesn't have a mind of its own. It doesn't. So how is it possible these economists, not you, Edward, of course, have the conceit to forecast economic activity, meaning human behavior, out into the distant future, like the five-year forward inflation rate? I mean, what is that about?
Well, that's what I do for a living, and
all right, everyone's got to make a living.
That's what I do for a living. I mean, If I couldn't do this, I'd be a movie reviewer.
All right. This episode of the Grant's Interest Rate Observer of the Air is brought to you by our friends at Health IQ and Away Travel, and you'll be hearing a lot more about them. And no ramping up the thing to chipmunk speed while I read these ads, because it's kind of discourteous to the paying advertisers. So we are sponsored in part today by Health IQ, an insurance company that helps health-conscious people like you, like runners, cyclists, weightlifters, vegetarians, boxers, get lower rates on their life insurance. So go to healthiq.com/grant to support the show and see if you qualify. Health IQ uses science and data, I suppose big data, to secure lower rates on life insurance for health-conscious people, including, well, like you, runners, hard bodies, people who do push-ups because they just feel like it, right? Just because it seems like the right thing to do. Well, those savings are exclusive to Health IQ. 56% of Health IQ customers save between 4% and 33% in their life insurance. And those savings, as I say, are exclusive to Health IQ. So if, like saving money on your car insurance or being a good driver, Health IQ saves you money on your life insurance for living a health-conscious lifestyle. Learn more and get a free quote at healthiq.com/grant. So Away Travel is helping to bring this episode of Grants to your ears. They make merely fabulous luggage with premium German polycarbonate, unrivaled in strength and impact resistance and very lightweight. So here, listen to that. That is one solid suitcase. So you can choose from a variety of colors and 4 sizes, the carry-on, the bigger carry-on, the medium, or the large. That's for extended stays. When you're going to see someone, you can say, I'll stay with you for 5 days. But in fact, you have it in the back of your head to stay for like 5 months, just like Tom Paine did when he visited his friends in Europe. So there's a lifetime warranty. If anything breaks, we will fix or replace it for you for life. 100-day trial. Live with it. Vibe with it. I guess that's millennial stuff, right? Vibe with it. Travel with it. If at any point you decide it's not for you, return it for a full refund. No questions asked. Free shipping on any Away order within the 48 states. Carry-on sizes that are compliant with all major U.S. airlines while maximizing the amount you can pack. So it says here that we're going to offer you the special offer, the unique URL, GrantsPod, GRANTSPUD. That's for $20 off a suitcase. Visit awaytravel.com/GrantsPod and use promo code GrantsPod during checkout. Now, Edward, a while ago, I think in 2003, I read in your book that a certain eminent University of Chicago professor, and in fact, let's name him Robert Lucas, declared that macroeconomics has succeeded.
Yep. Has
macroeconomics succeeded? And if it perhaps has not, what does that say about the art of central banking?
Well, I think Janet Yellen, I think it was in 2016, so it was just kind of the tail end of her term at the Fed, gave a speech, I think it was in Boston, a conference kind of re-examining macroeconomics. And it was an amazing speech because he basically said, here's several questions that I have for all you macroeconomists in the room that we really need to get a better handle on. And it included something like, what really determines inflation? How do we actually understand inflation? Which I thought, well, I guess we haven't really made any progress as macroeconomists. And by the way, I studied macroeconomics from her because she took the Tobin notes 6 years before I got there, and I studied from them. But I think central bankers are central planners. And I think you and I are probably on the same page on that one, that they have this conceit that monetary policy can solve a lot of problems. And that certainly has been...
Well, it can certainly create a lot of problems.
Well, they can create a lot of problems. The real issue here up ahead here is whether there'll actually be a price to pay for what they've been doing over the past 8-9 years.
10 years.
10 years.
What do you think? Is there a price?
Well, I tell people I'm not a preacher. I don't do good or bad in terms of policy. I'm an investment strategist. I do bullish or bearish. So I would say that, up until now, it's been bullish. I mean, I still think it's basically bullish. I think we've been extraordinarily, I don't know whether we've been lucky, because I don't think luck had much to do with why inflation has been kept down. But if inflation ever had come back along the way, I mean, if anybody told us that they were going to increase their balance sheets by the amounts they have over the past 10 years, most of us would have said, no way that's going to happen, because somewhere along the way, inflation is going to come back and they're going to have to squelch it all. But they have rigged markets, they have distorted markets, and history shows that if you do that for too long, once you start to reverse course, something cracks.
And what are you doing with your money? And if I may ask, and what are you telling your clients to do with theirs?
Well, I don't really want to worry about my own personal portfolio at the same time as I'm giving advice about the market. So it's always been, I mean, I have a lot of clients that manage money, but it's actually been very passive in terms of keeping it in index funds and bonds. So I haven't made a lot of money. I mean, I've done well in my own account just with pretty much vanilla kind of investments. But I don't want to have a situation where the market's taken a dive and my personal circumstances are emotionally affecting my judgment about the markets.
What, in your view, as someone who has not only seen risk and understood them, but also knew which risks not to pay attention to, what is the most significant risk of financial and investment consequence that you see?
Well, I think we've been circling it here, and that would be that I could be wrong. It's happened before, and inflation makes a startling comeback. How
about China? How about China with showing bank assets at 51% of GDP, never before seen or imagined?
I would put that on the list, maybe as number 2 or maybe as a contender for the number 1 position, because while everybody keeps focusing on the Fed, the BOJ, the ECB, the real big story has been the what's going on in China and their monetary system. And I've been pointing out on a monthly basis, I said, look, in 2008, the Chinese banks had loans of $5 trillion. Today, they have loans of $20 trillion. I mean, it's just extraordinary. Now, in some ways, they remind me of Japan because, everybody said, well, nobody really cares about the excesses in Japan because they owe it to themselves. And it's the same thing in China. If you look at M2, their deposit growth has been in line with their bank loans. So they've been they have a very high savings rate there, and they've been leveraging it up to the hilt to keep things growing, and they just can't figure out any other way to keep themselves growing other than continuing to base it on debt. So, but as you know, the China doomsday scenario has been around for a long time, and
hey, so was the mortgage doomsday scenario in 2007.
Yeah. I mean, at some point, something, things that are of concern could become a real serious issue.
What movie should we see? One. You only got one.
Get out.
Okay. Ed Yardeni, movie critic, father of 5, a scholar, and right on the money thinker about markets and economics. What a pleasure to have you, and congratulations on your book, Edward, Predicting the Markets, Edward Yardeni.
Thank you, Jim.
So that does it. That does it for today. Thank you, Ed Yardeni. Thank you for being with us. Oh, yes, we are also sponsored by us. So, subscribe to Grants, but also, how about a little personal interaction? Come to the conference at the Plaza Hotel on April 10th, and you will see a panoply of thoughtful people and hear them too, and it's going to be stupendous. So April 10th at the Plaza Hotel. See you there, and talk to you next time on the Grants Interest Rate Observer podcast.